October 14th, 2018, 3 minutes past midnight. A single line of code executes, not in some back alley server room, but on a sleek, climate-controlled desk in a city that prides itself on innovation. What happened in those next 72 hours would trap millions, quietly, efficiently, and with the full blessing of the internet. How could the tool designed to bridge financial divides become the most sophisticated debt trap ever engineered? The answer lies not in physical doors slamming shut, but in algorithms learning how to whisper promises of quick cash directly into your smartphone. We begin not at the start, but in the echo of the crash. Think of the 2008 recession, the foreclosure signs, the desperation clinging to every front lawn. Out of that wreckage, millions found traditional banking closed off. They needed $50 for a prescription, $200 for a broken-down car. They went looking for a short-term fix, a bridge over troubled water. What they found instead was a digital siren song, an app promising instant approval, no credit check, just a few taps away from relief. This was the new frontier of lending, and it looked clean, modern, irresistible. The first click felt like freedom. A simple application, minimal information requested, and within minutes, funds hit the bank account. A quick fix, they thought, a temporary inconvenience. But the true cost wasn't listed in the fine print. It was baked into the very structure of the transaction. The initial fee, disguised as a service charge, was astronomical when annualized. A manageable $100 due in 2 weeks suddenly became $120, and when that deadline arrived, and the borrower fell short by just $20, that's when the machine truly started to grind. The repayment wasn't due, it was rolled over. A small fee paid to defer the principal, pushing the inevitable further down the road, each deferral compounding the interest into a suffocating blanket. The system didn't rely on brute force or menacing visits. It relied on automation, a constant, relentless digital drumming. Imagine the borrower staring at a screen, the glow reflecting the anxiety in their eyes. The notifications begin subtly, a polite reminder, then a slightly firmer tone. Then the language shifts. The friendly chatbot disappears, replaced by aggressive, templated threats. Failure to comply results in immediate escalation. Escalation to what? In the pre-digital age, you knew the threat. A collector would call, maybe show up. Here the escalation was entirely opaque, terrifying precisely because it was unseen. It was the fear of the unknown variable in the code. The story pivots now, back to the genesis of this digital predator. In the early 2010s, a cohort of finance graduates, steeped in data science and frustrated by the cumbersome regulations of traditional lending, saw the potential. They didn't see people needing help, they saw predictable patterns of fiscal distress. They saw opportunity in the friction points of the mainstream economy. Their innovation wasn't the high interest rate that had existed for centuries. Their innovation was the delivery mechanism. Why maintain physical storefronts, pay rent, and employ cashiers when you could build an interface so smooth, so frictionless, that accessing predatory debt felt like ordering takeout? They perfected the user experience of desperation. A bright, welcoming interface that masked the internal gears grinding away, calculating maximum sustainable extraction. The key insight, the secret sauce that unlocked true scalability, was the harvesting of data. Every transaction, every late payment, every answered or ignored text message fed a proprietary algorithm. This wasn't just about predicting who would default. It was about predicting who would roll over. The system was optimized not for repayment, but for perpetual indebtedness. If you could keep someone paying 400% APR for an extra 6 months, that was pure profit maximization. Think of the language they used in their internal memos. It wasn't about service, it was about lifetime customer value. A customer wasn't a person in need. They were a data stream providing predictable, recurring revenue, even if the principal was never touched. This cold, mathematical detachment allowed the creators to sleep soundly while their product destroyed financial stability nationwide. They weren't loan sharks, they were actuaries of misery. The regulatory landscape predictably couldn't keep pace. State lines meant nothing to an application hosted on a server farm in a jurisdiction with lax oversight. A physical loan shark had geographic limits. The digital iteration was borderless. Attempts to cap interest rates were sidestepped by labeling the charges as technology fees. data processing costs, or accelerated service premiums. The lawyers were as clever as the programmers. Now let's look closer at the tactics employed once the digital net was set. The calls stopped being human. They became robotic, highly personalized barrages timed specifically for maximum psychological pressure during work meetings, late at night when children were sleeping, right before payday when the anxiety of non-payment peaked. And the threats, the subtle escalation we mentioned earlier, became terrifyingly specific. The algorithm knew where you worked. It knew the names of your emergency contacts. It didn't threaten legal action, which is slow and expensive. It threatened exposure. Your employer will be notified of your fiscal irresponsibility by 9 a.m. tomorrow unless payment is received. This threat, often empty, carried enormous weight because the borrower had already handed over access to their digital world during the initial sign-up. That initial agreement, signed in haste, authorized a level of digital intrusion that would make a government spy blush. The central mystery we must solve is this: how did the victims, intelligent people trapped in momentary crises, fail to see the cliff edge until they were already falling? The answer lies in the architecture of the interface itself. They weaponized cognitive bias. The initial offer was framed using anchors of affordability, less than a cup of coffee a day, while the total repayment figure was obscured by scrolling interfaces and dense hyperlink policies. By the time the truth was visible, the psychological cost of walking away, the shame, the fear of losing the little bit of money they'd already secured, was too high to pay. They chose the familiar pain of debt over the terrifying void of immediate insolvency. The breakthrough moment for law enforcement, the moment they realized this wasn't just bad business, but systemic financial abuse, came not from a massive data breach, but from a single, desperate text message sent by a victim to a general consumer protection hotline. A message riddled with typos and panic. It contained a screenshot of a debt total that was mathematically impossible, based on the initial loan amount. The math didn't add up, but the digital ledger did, perfectly, according to its own internal, predatory logic. This single piece of evidence allowed investigators to trace the digital breadcrumbs back to the core servers. They found not a single loan company, but a network of shell corporations, each designed to handle one specific aspect: underwriting, collections, data processing, and liability insulation. It was a corporate hydra, designed so that if one head was cut off by a cease and desist order, two more immediately took its place under a slightly altered name. The digital loan shark didn't bleed, it simply recompiled. The final act of the story involves a raid, not on a physical office, but on the cloud infrastructure that hosted the entire operation. The moment the digital locks were broken, the automated systems sputtered, the relentless pings stopped. For millions of people, a chilling silence descended upon their phones, the first silence they had experienced in months, perhaps years. It was the silence of a machine temporarily broken. But the true cost lingers. The digital ledger, even when seized, holds the data of every transaction, every moment of weakness recorded, every threat made. The question remains long after the servers are shut down and the architects are charged. How do you unring a digital bell? How do you erase the memory of that pressure from the minds of those who believed, for a brief, desperate moment, that the speed of the internet offered them salvation, only to find it had delivered a cage built of ones and zeros? The ledger is closed, but the debt, in one form or another, remains etched into the digital fabric of their lives.